Welcome to Talking Business, a podcast produced in Melbourne, Australia. The podcast is available on the Acast site, my own website, the Apple Podcast Store, or wherever you go to get your podcasts. Or you can get it at the Business Acumen website at www.businessacumen.biz or at Banking Day. For the most exclusive access to leading economists and business leaders from around the world, subscribe to Talking Business from my website, leongettler.com. I am Leon Gettler. My job is to review and monitor the week's news in business, finance and economics. I bring it all to you every week. This is episode number 20 in our series for 2024, and today's date is Friday, June the 14th. First, I'll be talking to Chris McNamara, the CRO of Remote, and he'll talk about how it is strategically advantageous for businesses to consider remote work as part of their acquisition and retention strategy. And I will talk to AMP Capital Chief Economist Shane Oliver about Australia's latest inflation figures. But first, let's talk to Chris McNamara.
Well, Chris, remote work has now become the new norm. Tell us about it.
Yeah, Leon, I think that we've all experienced over the last couple of years the shift towards remote work. And I think what started as a bit of a reaction to the pandemic has actually become almost an awakening to the benefits of working from home and working remotely. And I think that's true not only on the employee side, but also on the employer side. And there's a whole bunch of research now that suggests that from an employee perspective, there are a ton of benefits from working remotely. As you'd expect, it's all about flexibility and work-life balance. But on the employer side, there's also data now that indicates that not only is employee satisfaction higher, people are happier when they're working remotely and working from home, they're actually also more productive, believe it or not. There's some research from a Stanford professor, Nick Bloom, who focuses specifically on remote work. And in a recent study, he found that remote working employees actually demonstrate higher self-rated job satisfaction, 35% lower attrition, and 11% higher productivity than their peers in the same role in the office, in the same company. And so I think more and more people around the world are becoming aware of these benefits. And we're seeing an explosion in interest for remote work.
Conversely, there are some companies who are saying,
Yeah.
You have to come into work.
Yeah.
And there's a challenge, I think, for companies to develop hybrid workplaces, to know who is in when and who comes in how many times a week and who doesn't come in at all. And so there's a whole challenge for them to develop those models. Yeah,
absolutely. And it's not the case that I think remote works for every kind of job in the world. That's certainly not the case. But my view and our view at Remote, the company that I work for, is that any job that's a knowledge-based role where you can reasonably perform it from a location that's not in person, there are very meaningful benefits to being able to unlock those types of roles to remote workers. And it's quite possible to put in place the type of infrastructure and process that you need to enable that remote work. And you've touched on some of those tools, but perhaps even more important than having the right tools and technology and process, I think you need the right culture. You need the right management to be in place, because it's not the case, in my experience, that working remotely is exactly the same as working in an office. And if, as a management team in a company, you expect those things to be exactly the same, I just don't think that that's going to work out. The expectations are different. I think you need to be really thoughtful about things like, how are you going to coordinate activity when people are working remotely? How are you going to share knowledge when people are in different locations and they're not in the office? How do you build culture when it's not about pizza and beers on a Friday? It needs to be something way more intentional when people are located in different places around the country, potentially even different places around the world. I work at a company where we have about 1,000 employees, Leon, and we're in 70 different countries around the world, 70. And it's simply not possible to try and work the same way that you would work if everyone were in the same place in the same time zone.
So remote does not have a head office? Is that what you're saying?
Yeah, that's exactly what we're saying. We don't have a head office. We're a fully distributed team. And, we work with companies that are fully distributed. We work with businesses that are hybrid. Some of their teams are in the office. Some folks are fully remote. Some people split their time. But there's increasing demand for distributed work amongst employees, and more employers are unlocking distributed work because they're finding it hard to source the right talent in the locations where they have offices. And so they're opening up the hiring funnel by opening up roles to locations that aren't in those places where they have an office.
The issue is someone working remotely would still want to be in touch with their supervisor.
For sure. Absolutely.
So the supervisor would need to have regular sessions with them, either remotely or whatever.
Absolutely. Yeah. I think that how you lead and manage in a remote context is a challenge in and of itself. And if you're an advocate of management by walking around, that's just not going to work, is it, in a remote environment? And so you do need to be intentional and thoughtful around, well, how do I create my relationship with my team? How am I going to help them understand who I am and what I'm about? How do I get to know them? How do I build culture within my part of the business? How do I understand their performance when I can't directly observe it at all times of the day? And it requires, I think, a different approach to management and perhaps a greater level of trust than what some managers may be accustomed to. But if you can make that leap, if you can take that step, then the benefits can be substantial. We work with customers who are opening up jobs in locations outside their home country. So an Australian company decides to open up roles in the Asia Pacific region. And we're finding that for certain types of roles, those companies are able to hire 50% more quickly because they're no longer competing for all the same people in exactly the same locations, potentially with businesses that are much larger than them. So it's a very interesting dynamic that's unfolding where companies, I think, are no longer bound by their physical premises in the same way that they once were.
But they would need a very different kind of manager to do that.
Yeah, I think I'm generally a believer that people can learn new things. And I think that over the next few years, remote work and distributed work models are not going away. I don't think we're going to see those disappear. And I think the main reason for that is that employee interest in flexibility is going nowhere but up. I think that companies that preclude flexibility for their employees will increasingly find themselves on the wrong side of the decision when prospective employees are choosing where they're going to work. And so, we do need to, I think, be thoughtful about investing in the capability of managers and leaders and how they think about leading globally distributed teams, or at least, domestically distributed teams. What does it take to build relationship and establish culture and manage performance in that type of environment?
That's interesting because it would suggest that remote work is becoming the new norm, but it would also suggest that companies that don't embrace it will have more trouble recruiting talent. Would that be right?
Yeah, that's absolutely right. And I think we're already seeing that there's some data that absolutely suggests that is the way that the market is moving. There was some recent data published by LinkedIn in the US that suggests that remote job listings represent between 10 and 20% of total jobs on the LinkedIn platform. But would you believe they represent about 50% of applications? So the amount of interest in remote jobs amongst job seekers is massive. It's huge. And I think increasingly companies that are not prepared to offer remote work or flexible working arrangements are increasingly going to struggle to attract the right talent, even if they're big brands. I'm not sure about you. I know a number of people who have left large technology businesses, great brands, super successful companies, because they've been called back to the office and they're voting with their feet. They're just kind of concluding, well, I can go elsewhere. I can choose something different. There's enough competition in the market now that, I can make a different choice for myself and what brings me fulfillment in life.
What's interesting with remote work is it also opens opportunities for people who would never be able to get work before. And I'm talking about, say, women coming back to work after having a family, or talking about disabled people.
Yes.
And I'm talking about people who are older people who are sort of already, might be in their 60s and 70s.
Yes. That is absolutely the case. And again, in the United States, for instance, there's emerging research that suggests that a lot of those groups that you've touched on, groups that may potentially be disadvantaged and underrepresented in the workforce and prejudiced, are being able to access opportunities via remote work because it levels the playing field. And some of those prejudices are removed within the context of an environment where all of a sudden it's not necessarily about kind of showing up at a physical place and who you know, and the relationship that you establish in person and the rapport that you have based on the things that you share in common. And it's all about your ability to deliver and the quality of work that you have. And suddenly, minorities and women and the disabled and veterans are in a much greater position to gain access to these opportunities, where historically perhaps they're subject to a bunch of biases, conscious or subconscious, that influence their ability to find work. So I think this is actually an incredible development from the perspective of diversity and inclusion in the workplace. And actually, some of our customers, Leon, at Remote, they're specifically using remote work as a vehicle for increasing diversity of their teams. So they're actively looking to bring in the types of people that historically have not joined the business by reaching populations that they would otherwise not reach because they're limiting themselves to where their office is based.
Well, that's quite exciting. That's quite exciting.
I agree.
And it's very much the new norm.
Yeah. I think that's exactly right. I think that more and more we're going to see companies making certain types of roles remote accessible. Not every role. There are some roles where that's simply a requirement that you're in a physical location in order to perform the role. Well, of course, but knowledge-based roles, technology-based roles, I think increasingly will be open to at least some portion of remote work.
Yeah.
And there's huge demand for that, is what we're seeing.
Well, Chris, that's fascinating. And thank you very much for your time.
Yeah, of course. Thank you, Leon. It was a pleasure.
And now let's talk to AMP Capital Chief Economist Shane Oliver.
Okay, well, Shane, tell us about the inflation figures. They don't look that good.
They don't look that good. The numbers for April were on the high side at 3.6%. Our expectation was that inflation would have fallen from the 3.5% monthly number that was seen in March. So those numbers were certainly disappointing. There are some factors to consider, though. The monthly CPI is quite volatile. Secondly, it looks like there was a seasonal aspect to it, because the seasonally adjusted monthly CPI in the month was actually about 0.5% lower, the unadjusted number. So it's likely we'll see a bit of a pullback in May. In fact, May inflation over the last few years, 4 of the last 6 Mays have seen a negative number in the month itself. The other aspect to note is that there's increasing evidence of weakness in the economy, which I think also needs to be allowed for in considering those inflation numbers. So on the face of it, yes, they add to the risk of another rate hike, but our view remains that would be a big mistake, and that the next move in interest rates is still down.
It's interesting because the Productivity Commission this week awarded 3.75% pay rise, but it warned that falling jobs and weak productivity is holding back wages. I'm wondering what impact that would have on the RBA.
Well, I guess the Fair Work Commission, which awarded that 3.75% rise, noted that there was a bunch of reasons arguing against a higher rise. On the one hand, they wanted to provide an increase for workers, and there's about 22% of workers affected by the award wage increase and the minimum wage increase, and about another 3% indirectly affected. So all up, it affects about 25% of the workforce. The Productivity Commission perhaps had considered a bigger rise. The ACTU wanted a 5% increase, but the Productivity Commission warned that productivity growth has been quite low, particularly in some of the sectors affected by award rates of pay, such as hospitality and so on. And secondly, they also pointed out that the budget included cost of living relief, there's tax cuts coming up, and there's also an increase in the superannuation guarantee of 0.5%. So all of these things were taken into account in their decision. But a 3.75% rise is well below last year's rise of 5.75%. And last year the minimum wage went up by 8.65%. So whichever way you cut it, these numbers are well down on a year ago. They are consistent with current wages growth. They do give workers a bit of a real wage rise if you compare it to the 3.6% inflation rate. But they're also consistent, I think, with continuing to get inflation down. If that number had been, say, another 5% or 5% plus rise, then I think the RBA would be a lot more concerned. But the fact is we are seeing award wage growth going up at a much slower rate than was the case a year ago, and we're also seeing increasing evidence that increases in wages for independent or individual contracts and enterprise bargaining agreements, which are the other two main components driving wages, that they're also slowing down. So I would take all of this as being consistent with less wage pressures starting to flow through the economy, which is consistent again with the RBA holding for a time and then ultimately being able to cut interest rates.
Well, the other issue too is Australian growth figures, with GDP numbers showing that Australia is unlikely to grow more than 1% for the next few months, over the next year.
Well, yeah, the economy is slowing down, and I think it's probably slowing faster than the RBA's been forecasting. We are seeing extreme weakness in consumer spending. Consumer retail sales, as measured, still look high, but if you allow for the fact that they've been inflated by high inflation or price rises, and that we've also had very strong population growth, if you adjust for those two things, it looks like real per capita retail sales have fallen into a giant hole, taking us back to where we were at the dark days of the pandemic. So that, I think, is a big drag. We're also seeing weakness in housing construction, non-dwelling building. Engineering activity has been a little bit weaker, although that one's probably a bit temporary. And the trade side of the economy is quite soft. So all of these things do run the risk that the economy is, a potential risk of falling into recession here, which I think is another reason why the RBA has to be very cautious. We know from history that if you want to get inflation down, recessions invariably do it. We've already got inflation down from around 8% to around 3.5%. I have no doubt that if we slide into recession, it will become even harder for companies to raise prices, which will put more downwards pressure on inflation. So the RBA does have to allow for the fact that economic indicators, particularly for consumer spending, are now looking pretty weak.
The kicker in the latest inflation figures were the price of rents. Now, they continue to go up, and I would imagine that's because of the housing shortage that we've got. And that's going to be a pressure on inflation, is it not?
There's no doubt that there's bits of the CPI. The CPI covers lots of things. Some bits will still be going up when the average has been coming down. So rental inflation has been accelerating, even though the overall inflation rate has fallen from 8 to 3.6. So, yes, there's always bits of the CPI which go in different directions. But the fact is that rents are still under upwards pressure because of the housing shortfall, and that is a major structural problem in the economy. And, of course, you look at another category, insurance, general insurance. Rates have been going up because of natural disasters, which has led to increased claims. There's not much that higher interest rates can do about those things, at least in the short term. But I I suspect that as the economy slows, you're going to see ongoing weakness in goods price inflation generally. People will be going to the restaurant less. That's going to make it much harder for takeaway and restaurant meals out prices to keep rising. People end up delaying getting haircuts and all those sorts of things. So there's going to be a big chunk of the economy which will see less demand, or is already seeing less demand, which then makes it a lot harder for businesses to put up their prices, even though we have this ongoing housing crisis.
And it'll make it harder for businesses to, frankly, to stay in business, because we're seeing a rise in insolvencies as well.
The rise in insolvencies is consistent with the slowing economy. That's true. So it's another indicator you'd look at, confirming that things are slowing down. Now, part of that rise in insolvencies, you know, we see headlines of record insolvencies. Part of that is due to a catch-up. Through the pandemic, some of the rules around trading while insolvent were put in abeyance, and so we saw less insolvencies reported through that period. So there is a bit of a catch-up there, but nevertheless, these numbers are going in the wrong direction and are telling us that companies are, like many households, are doing it tough. And we hear lots of stories about companies which have closed. There's cost pressures, interest rate pressures, now slowing demand. That's why I think we've come into a situation which is now a very difficult balancing act. Yes, inflation is higher than we would want it to be, but responding to that in a knee-jerk reaction, just raising interest rates again, just risks further deteriorating the economy and end up with an overshoot on inflation on the underside, where inflation ends up falling too far. So a very difficult balancing act for the Reserve Bank at present.
Indeed, and the thing you said was that the latest figures were monthly. They tend to be volatile. So you're expecting the quarterly figures will show.
Well, there is this problem in Australia. We introduced a monthly number 18 months ago, I think it was now, end of 2022, in fact. Part of a catch up to other countries that have monthly CPIs, but the problem is that it does bounce around a lot and confuse people. You know, for the first 2 months of this year, we saw some very low inflation numbers, and that provided optimism that inflation was coming under control. And then suddenly we get to March, and the March quarterly numbers, and they're higher. So that is confusing things a little bit. But I think the quarterly number still remains the gold standard for the RBA. That's the one they focus on the most. Their forecast for this quarter is 3.8%. Inflation, which is above the current monthly number of 3.6%. I have a feeling that probably won't get that high because, you know, the monthly is 3.6. We're probably going to get a lower number for May. The economy is looking weaker. So I think the Reserve Bank could find that the quarterly number could come a little bit below its own forecast. But at the very least, they would probably look at it and say, okay, it was 3.6% in the month of April. We're forecasting 3.8% in the quarter. It's no surprise for us. We were expecting a rise. And so again, that would be an argument for them not to raise interest rates because the inflation numbers are consistent with their own forecasts. What will be most important for the RBA in the August meeting, I think the June meeting in a few weeks' time, is probably just going to see rates left on hold. There hasn't been enough information to justify their assessment. They've already done enough. And that inflation will fall back to within target next year and the year after. So what will be critically important will be the August meeting, where they'll get the June quarter inflation numbers, where I suspect it could come in a little bit below their 3.8% forecast, and then they'll review their forecast going forward. If they revise up their forecast for the next couple of years, then that would be a big concern and probably tip them over into a rate hike. But I think that's most unlikely. I think they will allow for the weakening in the economy weighing on inflation, and that will see them leave interest rates on hold at that August meeting. But that's going to be the key once we get those September quarter, that June quarter inflation numbers, but that's still a couple of months away.
And you're still forecasting a rate cut in December?
Yeah, we still expect a rate cut at the end of this year, and that will be in response to signs of weaker inflation numbers and weaker economic growth. It is noteworthy that the US, which led Australia on the way up, in inflation and led it on the way down. It's been leading by about 6 months. It also went through a hotter patch for inflation through January, February, March, but the numbers there seem to be improving a little bit lately in the US. And we've also seen some ongoing evidence the US economy is weakening, which is providing more confidence that the Fed will be on track to cut interest rates later this year, probably around September. So I suspect the RBA is to some degree following the US with a bit of a lag. We are seeing weaker growth here. I think that will show up in weaker inflation numbers and we'll end up cutting sometime after the Fed, but probably around December.
Well, Shane, thank you so much for your time.
Thanks, Leon. Take care.
So what's happening in the news? Well, Peter Dutton has escalated the climate wars by declaring the coalition will not release its 2030 emissions reduction target until after the next election, while also accusing the pro-climate Teals of being closet green, who are out of touch with their voters. As the Teals returned fire, saying the opposition leader had given up on winning back the crucial Liberal seats, Prime Minister Anthony Albanese, who announced Labor's 2030 target when in opposition, said Mr Dutton had effectively abandoned the Paris Climate Accord. In doing so, he would subject cost-of-living weary voters to another climate change election, which they did not want, he said. This is not a sensible policy. This is an abandonment, he said, confirming the coalition would junk Labor's legislated target to reduce emissions by 43% on 2005 levels by 2030 because, he said, it was unachievable and would drive up power prices. Mr Dutton said voters would have to wait until after the election to know his plan. We'll look at the prevailing economic conditions after the next election and we'll make announcements in due course, he said. He said the coalition remained committed to net zero emissions by 2050, but the trajectory to get there need not be linear, meaning the coalition would bank on nuclear power doing all the heavy lifting on carbon emissions reduction sometime after 2040. A strategist said Liberal voters who switched to Teal at the last election because of climate change will be far less likely to return to the fold, and younger voters want action up front on climate change. They see 2050 as too far away to be of consequence, the strategist said. Mr Dutton needs to win about 20 seats to form majority government, and the orthodox view is that this will be impossible without regaining some or all of the Teal seats. Amid growing nervousness among Liberal moderates about the impact of the fracturing of the climate breakout, one strategist said it would have some appeal in the suburbs and regions, but it would play poorly in the 6 once safe seats the Liberals lost to the Teal movement the last election, due largely to the coalition's record on climate change policy. And French building materials giant Saint-Gobain has received approval from Australia's Foreign Investment Review Board for its $4.3 billion takeover of CSR. The board of CSR agreed to the $9 per share bid from Saint-Gobain in late February, and shareholders will vote on the proposal at a scheme meeting scheduled for Thursday. CSR is one of Australia's oldest companies, after being founded as a sugar refiner in 1855. CSR has told the ASX on Tuesday that Saint-Gobain had received written approval from the federal government, that it had no objections to the takeover. CSR shares gained 1 cent to close at $8.96 on Tuesday. The CSR board reiterated on Tuesday that it unanimously recommended the takeover bid by Saint-Gobain. Another of the ASX-listed building products groups, cement maker Adbri, is set to fall to foreign ownership on Wednesday when shareholders vote on a proposed $2.1 billion buyout by Irish company CRH, which is listed in New York and London. CSR makes gyprock plasterboard, PGH bricks and pavers, Monia roof tiles and Hebel lightweight building block. It also has a 25% stake in the giant Tomago aluminium smelter in New South Wales. A $29 million loss from the aluminium division in the 12 months to March 31 was a handbrake on CSR's overall results. The Tomago smelter has battled against volatility in aluminium prices and soaring electricity costs. CSR reported in mid-May a 6% rise in net profit after tax to $231 million for the 12 months ended March 31st. CSR Chief Executive Julie Coates said the core building products business generated a solid 8% rise in earnings before interest and tax to a record $294 million, pushed along by price rises and cost discipline. Margins in the building products business increased to 15.5% from 14.9%. And former Federal Treasurer Peter Costello has resigned as the chairman of Nine Entertainment after days of acrimony following an altercation with a journalist in Canberra Airport. Mr Costello was appointed chairman in 2016. He'll be succeeded by Catherine West, a former Sky executive in the United Kingdom and Nine's current deputy chairman. Nine confirmed Mr Costello's resignation on Sunday afternoon. His exit follows a lengthy board meeting on Friday, Monday, convened hours after Mr Costello was involved in a messy altercation with a journalist. A reporter from the Australian ended up sprawled on the ground after filming himself peppering Mr Costello with questions about Nine's handling of the departure of television news boss Darren Wick. Nine's share price has fallen to $1.40, down 30% this calendar year. It is at its lowest price since the start of the COVID-19 pandemic, when it fell about 94 cents. Mr Wick was paid out, and allegations from multiple staff emerged of his drunken and lecherous behaviour in reports published by the Sydney Morning Herald, The Australian and Sky News Australia. Mr Costello rejected the suggestion he had touched the Australian's journalist on Thursday evening. There was no assault. He was backing back. He hit an advertising placard. I did not lay a finger or a fist or anything else on him, he said. Regardless, the interaction piled pressure on Mr Costello, who was accused of behaving aggressively towards a working journalist. Nonetheless, Costello did not leave gracefully. He had a shot at the new Chair West in his statement announcing his decision. The board has been supportive through the events of the last month and last few days in particular, but going forward I think they need a new chair to unite them around a fresh vision and someone with the energy to lead that vision for the next decade. And a lack of consumer spending in the first half of 2024 has resulted in significant strain for retail businesses, according to a recent Creditor Watch study. There are a variety of sub-industries feeling the strain, but according to the report, those with the highest proportion of business failure in the last 12 months were fuel retailing 5.4%, food retailing 5.4%, other store-based retailing 4.96%, non-store retailing and retail commission-based buying and or selling 4.49%, motor vehicle and motor vehicle parts retailing 4.27%. The Treasury has forecast incoming tax cuts and cost of living incentives in the budget, but Creditor Watch are sceptical as to whether this will affect consumer spending habits. In a statement, the organisation said spending will likely stay down until there are 2 or 3 cuts to the cash rate. The rising cost of living is driving many of these trends, with non-essential spending becoming more and more of an afterthought. However, Creditor Watch noted that the food industry in particular has shown continued resilience. This sub-industry faces its own issues, with things like higher proportions of overdue invoices and a trend of consumers moving away from smaller food suppliers in favour of value supermarket chains. Food was recognised as performing better than other store-based retailing. According to ABS data referenced by Creditor Watch, spending is down year on year in household goods 1.4%, clothing, footwear and personal accessories minus 2.5%, and department stores minus 1.3%. And Chemist Warehouse's $8.8 billion merger with Sigma Healthcare raises common sense competition concerns, as the company will own more than 16% of the country's retail pharmacies, a Singaporean hedge fund research firm says. Analysis by Wickham's Hill suggests the merged company, with 864 outlets under the Chemist Warehouse, My Chemist, Amcal and discount drugstores brands, will become the only major pharmaceutical group in Darwin and control 68% of Melbourne's market, excluding the small community sector's chemist outlets. At a national level, Wickham's Hill's analysis said the combined group would own 16.1% of the country's retail pharmacies, or 47.7% of the market if the smaller independent operators were excluded from the calculation. Nationally, the group would account for 17.1% of all pharmacies in city areas, said Wickham's Hill analysts Lloyd Moffat and Jordan Green. Without independent operators, the new group would represent nearly half of the market across these areas, followed by Wesfarmers-owned Australian pharmaceutical industries with 21%. Despite opposition from the influential Pharmacy Guild, which represents a small chemist, the market has priced little chance the deal, the share market's largest reverse listing, will be blocked or substantially recut by the Australian Competition and Consumer Commission. And Bapcor's 3 profit downgrades and 27% share price decline in 12 months have an opportunistic suitor sizing up the $1.49 billion automotive parts retailer. Bain Capital has made a $1.83 billion buyout proposal for Bapcor, the struggling automotive parts retailer told investors on Tuesday morning. Bapcor runs the Autobarn, AutoPro, Burson and Midas chains and has 1,100 outlets selling car parts to mechanics and to motoring enthusiasts. It disclosed Bain's offer. Bapcor said that it had received an unsolicited, conditional and non-binding proposal at $5.40 per share from Bain after share market close on June the 7th. Bapcor shares closed at $4.36 on Friday. The shares were above $7 last year. Bapcor, which was known as Burson Group until 2016, listed at $1.82 in 2014. More recently, it has been forced to downgrade profit expectations 3 times in a year. The last one in May, a disclosure which sent its shares tumbling 35% in a day, wiping more than $500 million in a share market value. The company had performed well under its former chief executive Darryl Abotomy. However, he was forced out by the board in 2021. Margie Heseltine, chairwoman, said it was an opportunity for Bapcor to install a more contemporary leadership and management approach to drive the company's growth. Noel Meehan was installed as chief executive, but left after 2 years. Mr. Meehan bought in consulting firm McKinsey & Co., and their work was the basis for a program known as Better Than Before, designed to deliver deliver $100 million in extra profits by 2025. Paul Dumbrell, a former V8 supercars driver, was announced as Mr. Meehan's successor in February. However, he surprised shareholders by announcing he had changed his mind on the May the 1st, one day before he was meant to start. And Lion, one of the largest drinks groups in the world, intends shutting a craft brewery in inner Sydney that has been operating for 36 years as rising costs, a shrinking beer market and consumer spending cutbacks take their toll. Lion, which makes 4X Gold and Tooheys, said it would shut the Malt Shovel brewery in Camperdown by the end of August and transfer brewing a product to other plants in northern New South Wales and Geelong in Victoria. The move follows a decision 3 weeks ago by Asahi, its largest rival, to close one of its own craft beer operations in Victoria. Asahi, Australia's biggest beer company after the acquisition of Carlton United Breweries for $16 billion in 2020, shut down the Matilda Bay Brew Pub in Hillsville in Victoria's Yarra Valley on May the 19th after 5 years of operation, citing high costs. A string of small craft brewers around Australia have already collapsed in the past few months as rising costs and consumer spending cutbacks mean they are no longer viable. Lion and Asahi, which have much stronger balance sheets, are feeling the same pinch in an overall beer market that has shrunk by 6% in the past 5 years. Lion Managing Director James Brindley said staff at Malt Shovel had been informed of the difficult decision of a proposed closure at the end of August. He said beer producers were in a difficult period, with overall volumes declining in Australia by 100 million litres since 2019. The Malt Shovel brewery makes a range of beers including James Squire, Umundi, New Belgium and Little Creatures. That production will be transferred to other Lion sites. And hundreds of employees of embattled budget airline Bonza have had their employment terminated after 2 months without pay. Company administrators told the 323 employees they were terminated immediately. Administrators Hall Chadwick set a deadline of last Friday for potential buyers to submit offers to buy the airline. No offers were received. Bonza still remains in voluntary administration, meaning employees are not yet entitled to the federal government's fair entitlements guarantee for unpaid wages. Hall Chadwick partner Kathleen Vuris said the administrators were investigating possible insolvent trading. About 200 staff joined the meeting, including a weary-looking former CEO, Tim Jordan, who did not say anything. Several employees vented their anger that the meeting started 15 minutes late, with one saying it was very disrespectful to keep hundreds of staff waiting. And Generation Z are changing the way work is done across the country through their quick adoption of AI, leaving their boomer bosses and colleagues behind. Those born between the years 1996 and 2012 are adapting to the technology faster than any other cohort, according to the EY Future Consumer Index report on AI. Gen Z's quick uptake would begin to change the way the older generations worked, as younger, more technology-proficient workers influenced new AI systems and tools. EY's Chief Technology Officer, Catherine Boycook, said the generational shift, which many tech experts have long forecast, was now becoming a reality. Gen Z's quick uptake would begin to change the way the older generations work, as younger, more technology-proficient workers influence new AI systems and tools. I think that we will start to see a large reverse mentoring or intergenerational mentoring programs, Ms. Boycook said. We'll start to see Gen Alpha and Gen Z team members reverse mentoring more senior leaders in the organisation on how they're using AI to transform the way they work. Ms. Boycook was commenting on the back of EY's index, which found that Gen Z's AI comprehension have more than doubled over the past 12 months, from 14% to 33%. Millennials were not closely following their young counterpart, while Gen X and baby boomers had even less comprehension. Baby boomers appeared to be the least interested in improving their skills, while their comprehension rate was not rising at all over the past year. Across workplaces more broadly, about 71% of respondents claimed to have some understanding of AI, up from 67% in October last year. That finding could relate to the slower or lack of adoption from baby boomers, as not all of the Gen Z cohorts are of working age, with the youngest just 12 years old. Part of the growing divide in the adoption of AI could be put down to the speed at which the technology was developing and the vast difference in digital environments. And that's it for this week. And next week I'll be talking to Anthony McClure, the Managing Director of Silvermine, and I'll talk to Indeed economist Callum Pickering about the latest unemployment figures. For the most exclusive access to leading economists and business leaders from around the world, subscribe to Talking Business from my website, leongettler.com. If you like Talking Business, please leave us a review with Apple Podcasts. Thank you in advance. In the meantime, you can catch me on Facebook, Twitter, Instagram, LinkedIn and YouTube. And if you want, leave a comment. If you want to contact me, email me at leon@leongettler.com. I answer all emails. Wishing you all a safe and healthy week and looking forward to bringing you Talking Business next week.